The culmination of the entire accounting cycle is the preparation and presentation of financial statements. These are structured, formal reports that articulate the financial performance and position of an enterprise, governed by a strict hierarchy of accounting standards, such as the International Financial Reporting Standards, IFRS, and, in the Indian context, the Converged Indian Accounting Standards, Ind AS. These statements are not merely a summary, but the primary vehicle for communicating financial information to a broad spectrum of stakeholders, including investors, creditors, and regulatory bodies. A complete set typically comprises the statement of profit and loss, the statement of financial position or balance sheet, the cash flow statement, and the statement of changes in equity. This session will dissect these reports and the analytical techniques used to interpret them. The utility of financial statements extends far beyond statutory compliance. For internal management, they are indispensable for strategic resource allocation, performance benchmarking against budgets, and exercising financial control. For external stakeholders, they provide the data necessary to assess profitability and operational efficiency via the income statement, and to evaluate solvency and liquidity through the balance sheet. Critically, the standardized format allows for rigorous inter-firm and intra-firm comparative analysis, enabling the evaluation of a company's performance relative to its peers and its own historical trends. This quantitative basis is fundamental to informed investment, credit, and valuation decisions. The statement of profit and loss, or P&L, measures the financial performance of an entity over a specified accounting period. It operates on the accrual basis and the matching principle, systematically matching the revenues generated during a period with the expenses incurred to generate them. The multi-step format, as prescribed by standards, provides critical subtotals. Gross profit indicates the efficiency of core production or service delivery. Operating profit, or EBIT, earnings before interest and taxes, measures the profitability of the firm's primary business operations, excluding financing costs and taxes. Below the EBIT line, the statement accounts for non-operating items. After deducting interest expenses, we arrive at profit before tax, PBT, which is the base for calculating corporate income tax liability. The final and most scrutinized figure is the net profit after tax, PAT, also known as the bottom line. The statement of financial position, or balance sheet, presents a static snapshot of the entity's financial position at a single point in time. It is a detailed representation of the fundamental accounting equation: assets equals sign liabilities plus equity. Modern accounting standards, such as Schedule 3 of the Indian Companies Act, 2013, mandate a vertical classified format. Similarly, the equity and liabilities side is classified. Equity, or shareholders' funds, represents the owner's residual claim on the assets. Non-current liabilities are obligations due after more than 1 year, such as long-term borrowings. Current liabilities are short-term obligations due within the operating cycle, like trade payables. The preparation of financial statements is merely the first step. Their analysis is what yields actionable intelligence. The primary objectives of financial analysis are to assess the firm's performance in 4 key areas: profitability, liquidity, solvency, and operational efficiency. Horizontal analysis, or trend analysis, compares line items across multiple periods to identify the direction and magnitude of change. Vertical analysis, or common size analysis, expresses each line item as a percentage of a base figure, typically total revenue for the P&L and total assets for the balance sheet. Ratio analysis is the most powerful quantitative tool. It establishes mathematical relationships between various financial statement items. Liquidity ratios, like the current ratio, measure short-term solvency. Leverage ratios, like the debt-to-equity ratio, assess financial risk and capital structure. A complete analysis requires examining the cash flow statement. Accrual-based profit can be misleading. A profitable company can face insolvency if it cannot generate sufficient cash. This statement reconciles net profit to net cash flow by categorizing all cash movements into 3 activities: operating, investing, and financing. Finally, the statement of changes in equity provides a detailed reconciliation of the opening and closing balances of the shareholders' equity accounts. It begins with the opening balance of share capital and retained earnings, adds the net profit for the period, subtracts any dividends paid. In conclusion, financial statements represent a comprehensive and regulated framework for corporate reporting. A thorough analysis using horizontal, vertical, and ratio techniques is essential for any stakeholder to transform this data into a nuanced understanding of an entity's financial health, risk profile, and future prospects.